Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market. From global macroeconomic trends to sovereign credit developments to regulatory and political changes.
Welcome to Fitch Ratings Fixed Interest podcast. My name is David Prowse. It's the middle of the summer, so today we decided to do some stock taking on the issues that matter most for global credit. And to do this, I'm pleased to be speaking once again to Justin Patrie, Head of Credit Commentary and Research at Fitch Ratings. Justin is the author of Fitch's semi-annual Global Credit Outlook reports and the quarterly Global Credit Risk Outlooks. Justin, you've recently published both a mid-year Global Credit Outlook and the Credit Risk Outlook reports. How is Fitch viewing the global credit environment right now?
Thank you, David. It's always good to be a guest on Fixed Interests. It's always difficult to break down the world of global credit to just a few talking points, but there are a few big themes that really matter for the big picture and have quite consistently come up in our analytical overviews of core credit drivers at the regional and global and portfolio levels. So the first theme, I think, is economic deceleration. Our base case global economic outlook has consistently been for a slowdown in growth in 2025. And while the actual forecast numbers have changed somewhat since the beginning of the year, the core view that we are in a cyclical slowdown that is also underscored by a material rise in US tariffs remains. Cyclical slowdowns create issuer headwinds for many sectors and elevate the risk for a recession, where some ratings vulnerabilities at the sub-investment grade rating levels can certainly be exposed. The second issue I've already mentioned is US tariffs. It's been a roller coaster so far this year as investors, analysts, and governments have had to rapidly adjust assumptions and forecasts for US tariffs. But we now have some better sense that the US effective tariff rate is going to settle somewhere between 15 and 20%. That's kind of been the area where the recent frameworks that were agreed to between the US and Japan and the US and Eurozone are settling. So at that kind of 15% tariff number. So there clearly is a historic shift in US trade policy. We're moving to a far more protectionist position relative to less than a year ago. This is significant for the economic outlook and for global credit, particularly for certain countries and sectors. And so while the end number may ultimately be somewhat more or less than 15%, it seems clear that historically high US tariffs are here to stay, at least through the Trump administration. The third theme is deteriorating conditions for credit. We evaluate over 200 separate sectors for operating and business conditions, or in the case of structured finance, asset performance expectations. And we always do a mid-year update. And at our mid-year update this year, a number of these sector and asset performance outlooks were changed from neutral to deteriorating. This includes 6 of 8 sovereign regions are now on a deteriorating outlook. And global sectors, including autos, tech, chemicals, and leveraged finance, are also now with a deteriorating outlook, which essentially means that we expect the general sectoral environment for these sectors to be worse this year than last year. So the end result of a slowing economy, higher tariffs, and greater investor uncertainty is translating into a more challenging environment for credit. But the fourth and final theme I'll talk about is contrasting to the kind of challenging environment is ratings resilience. So even as the economic outlook and general credit conditions outlook, is weakening, our ratings portfolio is still looking quite stable. We've not seen a particular surge in negative rating actions in the first half of the year in a way that kind of occurred during the first year of COVID or during the global financial crisis, but nor have we seen significant rating outlook changes to suggest that the risks of large-scale negative rating action have grown.
Before we get further into discussing credit ratings, I'd like to ask you more about the bigger picture macro credit environment. You mentioned economic deceleration, tariffs, deteriorating sector outlooks for credit. But looking back first at the first half of the year, what were some notable surprises?
There weren't any real curveballs or surprises in the first half of the year in the sense of an event or trend that was not generally foreseen. Tariffs, for example, those weren't a surprise. They were well telegraphed in the 2024 US election, and we at Fitch and general investment community anticipated a clearly more aggressive protectionist policy from the US this year. However, I think where there was a surprise was the levels at which the U.S. was willing to go, especially as demonstrated with that April 5th announcement. This went way beyond most in-house expectations, and it was a shock to the markets when we saw tariff rates that were announced well in excess of 20%. And also to see bilateral tariff rates between the U.S. and China, start to go into the triple digits at one point. Now, there has subsequently been a pause. There have subsequently been some framework agreements that have been signed, and now, as of August 1st, there has been kind of a reimposition of tariff rates that are somewhere in between 15, 20, in some cases higher for certain countries. But it's important to note that the roughly 15 to 20% U.S. effective tariff rate, where it seems to be settling, is still historically very high and above most of the market's expectations prior to the inauguration in January. In addition to kind of the tariff rates, while not really surprises, given we've been highlighting elevated geopolitical risk for some time, the outbreak of direct conflicts between Israel and Iran and between Pakistan and India in the second quarter, these were certainly notable escalations that were maybe difficult to predict specifically, but generally expected. They were relatively short term, though, so the credit and regional economic implications were quite limited. And I think the third surprise, I'll just speak for myself at least, was kind of the nature and level of the market reaction in April following the initial tariff announcements from the US. So that so-called triple sell-off, where the dollar, US equities, and bonds were all losing value simultaneously, is a distinct and interesting phenomenon that I don't think we can ignore. During this environment, we did not see a traditional flight to safety to US Treasury bonds and dollar assets, like might typically occur during a sudden risk-off events. So since then, market valuations have recovered, but the dollar has still had a weak first half of the year. Treasury yields remain elevated. So there's something that worth noting about kind of the loss of investor confidence in U.S. assets that was kind of hinted at from that April sell-off.
And looking ahead to the rest of the year, what are the key things to watch?
Yeah, so there are several themes that came up repeatedly in our mid-year outlook assessments, regardless of sector, whether it was non-financial corporates, sovereigns, financial institutions, or structured finance. So these themes included trade and tariffs, obviously, geopolitical risk, financing conditions and financing stability, and more generally, how economies, consumers, and businesses are going to respond to this policy volatility, especially pertaining to trade. So we know that there is uncertainty related to geopolitical risk and trade and so forth. But it's how businesses and consumers are going to react. So we know that tariffs are the effective tariff rate is going to be probably between 15 and 20%. But there still is a great deal of uncertainty as to how disruptive this is going to be on a wider economic, sectoral, and capital markets level. Of course, we have an economic space case, which shows a slowdown in the global economy, led particularly by the US and China. But for example, it's more difficult to determine how corporate issuers are going to respond to this changing environment. What will their financial strategies be? Or how consumers are going to react to higher tariff-related prices? To what extent will the resilience of the US consumer continue to hold up? Or to what extent will price hikes be passed on by companies or be absorbed in their profit margins? And I know our banks and structured finance analysts are also looking closely at potential downside trends in the drivers of asset quality for their sectors. Markets are reacting well, generally, to the recent tariff agreements, or reacting in a relatively neutral way, because it enables investors to price out uncertainty. But we've yet to really see what historically high tariff rates are going to mean for businesses and consumers over the medium term. Again, to what extent it'll lead into corporate margins, to what extent it'll drive inflation, how price sensitive will consumers be. The volatility over tariff rates may be coming to a close as we can kind of price in a certain rate, but we're just at the beginning of how this might change business, consumer, and investor behavior. One of those feed-throughs has to do with capital markets and financing conditions, which have remained extremely strong. Equity valuations are near historic highs. EM and high-yield credit spreads are had historic, cyclical lows. And this is even though overall refinancing costs remain elevated, as U.S. interest rates haven't been cut. So we have a general sense that we're going to see a slowing economy, but exactly how tariffs will be responded to by economic actors remains an unknown.
We've spoken a great deal about top-down macro credit conditions, but what about issuer ratings? How have ratings performed during this period, and what is the outlook?
Yeah. So as I mentioned, ratings resilience is a key theme, I think, for global credit over the first half of the year. Now, ratings are through the cycle, which means they generally shouldn't shift through the ebbs and flows of a standardized business and an economic cycle. And it is actually quite a rare event that can cause large scale migration. And I mentioned COVID and the global financial crisis as kind of examples. Although in the case of COVID, I think it was more outlook changes than actual downgrades. And so despite all the uncertainty and news and coverage of tariffs, there hasn't actually been a significant event that has directly affected issuer credit profiles at a large scale yet. There was a China downgrade in April, which did cause a number of sovereign supported ratings to be downgraded, but that was not really a tariff related event, but a reflection of kind of longer term issues. And in fact, outside China, in North America, Latin America, and Europe, net rating actions for non-structured finance investment grade issuers were actually positive in the first and half the year. And for sub-investment grade ratings, it was broadly balanced at that global level too, and meaning that the number of upgrades was roughly the same as the number of downgrades. If we look forward, we have rating outlooks. Rating outlooks kind of give a signal as to generally whether a rating could be upgraded or downgraded or remain the same. And rating outlooks also remain broadly balanced, where negative and positive rating outlooks are at roughly the same level for the global level at a very big picture level. We have seen a slight uptick in sub-investment grade negative outlooks, but it's still not, frankly, that significant. In the second quarter, around 11% of our total sub-investment grade ratings had negative outlooks versus 9% positive, but those numbers exclude structured finance. There are a number of reasons for rating stability, but if we look at non-financial corporates, for instance, they're in a relatively strong financial position on the whole. They've got healthy balance sheets, they've got ratings headroom to absorb weakening economic and operating conditions. But of course, there is greater vulnerability at the lower ratings level.
And has the risk environment evolved at all?
Yeah, so you gave a nice plug to the quarterly global credit risk outlook report. This is formerly named Risk Headquarters. This outlines key developments in global credit risk, and in that report, we maintain a list of key risks. And we've updated our key risks in the latest report that was published in July, but the core themes really remain the same. Tariffs and how issuers and economies are going to respond. Geopolitical risks remain persistent. Policy uncertainty and market instability. These were the core things that we were thinking of as major risks at the beginning of the year, and they remain the same now. We've changed the headings, but the themes remain broadly the same. I will say that there's been some greater focus from our sovereign team about fiscal sustainability in developed markets, given the confluence of issues governments are facing there. And if I could give a plug to a new Fitch report, our sovereigns team recently launched a developed markets government debt sustainability monitor that tracks key indicators relating to this. Essentially, I think that the messaging is government debt is rising. It's becoming very politically difficult to address deficits and debt. Developed market governments have rising defense spending commitments. We've seen that with NATO, higher interest rates and social pressures, and all of this is combining to add to long-term fiscal challenges. Now, we saw some of the potential risks of this with the sudden sell-off in UK gilts way back in 2022, which could be indicating that government bond investors have a limit to what they're willing to tolerate when it comes to fiscal policy, and they could be becoming more sensitive to budget planning. So that's certainly something that has come increasingly in focus as well.
Thank you very much, Justin. And as always, thank you very much to our listeners. If you would like to learn more about Fitch's credit ratings and analysis, and to read our latest Global Credit Risk Outlook report, please visit our website at fitchratings.com.
Subscribe to Fixed Interests wherever you get your podcasts.